Welcome and thanks for joining us for our today's first ever webinar of Meet the Manager. Our manager today is Charlie Burgess, the CEO and Portfolio Manager for Westbourne Asset Management. Before we hear from Charlie, we need to keep the compliance team happy, so I'll read through the following disclaimer. Trade for Good does not provide financial product advice. The information presented today is general in nature and provides for educational information purposes only. It does not take into account your personal objectives, financial situations, or needs. Should you consider further the information is appropriate for you and seek independent financial advice where necessary. All views expressed in this presentation we do not necessarily affect the views of Trade for Good. Any reference to the past performance is not an indication of future performance. By continuing this session, you acknowledge and accept of this disclaimer. Morning, Charlie. How are you on this cold morning?
Yeah, no, very well. Came up from Red Hill this morning. It was pretty brisk, but good to be here. And thanks for hosting.
Pleasure. It's great to have you. So today I thought, Charlie, we'd run through the fun, what you do, your processes, and importantly, how you manage risk.
Yep.
And then at the end, we've got some time for some Q&A, and hopefully we can get some curly questions for you.
Yeah, all right, absolutely. Well, I've got a presentation, so let's load that up. And I'll. Thanks, Al. Yep. So Westbourne Absolute Return Fund is our new fund we launched as of August last year. Now, the management of the fund is Westbourne Asset Management. So we'll go through some details about my personal background. Is obviously some disclaimers to have a read through when everyone's got a moment. But to go through my personal background and again how the fund works through its process, its risk management, and our expectations going forward. So as I mentioned, Westbourne Asset Management is the investment manager. The investment vehicle is in the form of a unit trust, and the fund is Westbourne Absolute Return Fund. Silk Group is the administrator. They're the ones that price the units every month, and they're also the trustee. So what are we investing in? We're investing in Australian equities. We don't do anything international. I've traded global markets for many years, and I quite enjoy the 10 to 4 of Australian hours. So we are a long, short Australian equities fund. What does that mean? We can buy and we can sell shares. The investment objective is 10 to 20% annualized returns. We look at those returns over a 3 to 5 year event horizon. We do get some volatility of returns, as all do, but over time, we look to sit in that 10 to 20%. Over my career, I'm sitting at around 17% annualized. So how do we get those returns? Well, we're a highly active, technical, driven trading fund, and we obviously have fundamental and psychological oversight over on top of that as well. And we'll go through into some more details on how the fund specifically is run. Who is the fund for? Well, it's for wholesale clients, and the minimum investment is $100,000. What we do slightly differently, and what we would call our edge, is we have traditionally low correlation to equity markets. We'll discuss that in a bit more detail. We avoid drawdowns and enjoy volatility as such. So this is an active trading fund. This is not a buy and hold fund. This is not a hold equities for 3 to 5 year views, looking at small and mid-cap markets or anything like that. This is an active trading fund. There's also a philanthropic element to the fund, which actually partners in well with Trade for Good. And in fact, when we were doing due diligence on how we wanted to set up this new fund and our philanthropic approach, Trade for Good was inspirational in terms of where they've come from and what they're trying to achieve. And it's great to see Trade for Good and others in the market looking at things a little bit further philanthropically and not just all about absolute returns. So I'll spend a little bit of time discussing who I am and my background. And the reason I like to do that is because it certainly has built me as the trader that I am today. My background is slightly different to others out there, specifically in Australia. So I was educated in Melbourne and moved to London in 2005, where I got a job in capital markets at Citigroup. The idea was to be on the trading floor. I'd worked hard at university and through some trading programs to determine that a trader was where I wanted to be, or a fund manager. And so I went to the trading floor in 2005. And to be honest, I was a little bit, I wouldn't say shocked, but I was certainly surprised by the lack of fundamental knowledge that was on the trading floor in those times. It was It had been a good period for capital markets since the tech sell-off in early 2000s. And when I came to the trading floor in 2005, it was a busy, happening place. There was certainly a lot of people there. People have done very well. And I thought the fundamental understanding of markets was probably lacked. And so I decided to pivot and take myself to equity research and attempted to get a job in equity research for a couple of years. That worked out. And the view was always to come back down to the trading floor. So after 2 years in equity research, learning how to build models, understanding companies from the bottom up, as well as I made my way back down to the trading floor. That was around about September 2007. And those of you might remember that date specifically because that was when HSBC warned on the potential impact of subprime mortgages. Obviously, from that point on, the world changed a little bit, and 6 months later, we were right in the middle of the GFC. So I look at that period very fondly, and the reason why is because the education that I received in those following couple of years, both in the experiences I learned, but also the people I worked with, set me up to become a trader that I am today, and I have done historically. And so when we came out of the GFC, not only did people like myself witness things that you probably wouldn't have been able to teach, but the caliber of personnel coming out post-GFC 2008, 2009 was essentially the best of the best. And I'm not just talking at my firm, but across the street in London and New York. And so those younger generational traders or capital market participants benefited grossly from some fantastic leadership and fantastic mentorship through that period, because those that were left post-GFC were the best of the best and were able to trade through a variety of different markets. So I was taught by some pretty inspirational people, and I was extremely fortunate. I was very cheap and relatively ambitious. So I guess coming out of that period, I was given plenty of opportunity to succeed, plenty of rope. And fortunately, that went reasonably well. So during that period from when I was in London from 2005 to 2015, I witnessed a lot, and I also traded a lot. I traded Central European, I traded Russian equities, I traded Middle Eastern equities, I traded Greece during the European crises and debt crises. So I had a variety of different environments. I was very fortunate in what was a relatively short period of time. I was able to witness and experience many different markets in many different sectors in many different countries. So when we left in 2015, I was the head of resources trading across cash and derivatives, and that was trading metals and mining and chemical companies, utilities, oils and gas, and so on. At that stage, we were running about a $500 million book, of which I had a $200 million book, and returns were good during that period. It was a very successful period for the bank. It was a successful period for myself as well. So highly enjoyable and a fantastic experience. So when I returned in 2015, 2016, Westbourne Asset Management was born. And that is obviously the asset manager for this current fund. There has been a prior fund, which we'll discuss a little bit. What I used to do and what I do is ideally the same. I'm an active trader, and I have been since 2007, essentially. The only difference here is what I do on these shores is a lot smaller scale, minute compared to what we were doing overseas. So that's me. There'll be some reflections about how I go about things that, if you look back in terms of the GFC and learnings, it's correlated. There's an understanding. I trade the way I do, and I manage risk. Then I manage money, both my own and others, based on my experiences and my learned behaviours. So you'll see that pretty clearly come out during the presentation. You'll hear a lot of fundies talk about their investment process, and it's a vital part of running a fund. And it's not necessarily to know what you do right or how successful, but when challenges come, you need to understand that you have a process that can protect you, your capital, your investors' capital. And so the process is the most important aspect of funds management business. As I mentioned, I'm an active trader. So what that means is I use technical trading very heavily. So what I do is I look at a lot of charts. I unfortunately grew up on Bloomberg for me, which is a costly tool, but it is my storytelling mechanism. So I look at probably 300 to 400 charts a day. And what I'm looking at those charts is to tell me something, tell me a story, paint a picture for me. And that's why I have a heavy alert system and a almost quantitative analysis relative to charting. Then it goes through my process of understanding if that story that has been alerted to me, if it has any validity. So obviously being in equity research for a couple of years has given me a slight edge, in fact, that I can do my own research and I can build my own models and I can look at companies quite deeply in terms of fundamental analysis. So I go through that aspect. And look, that's not rare. Everyone does their fundamental analysis. One thing that I do slightly differently is give psychological analysis a lot of kudos in my process. So I look at market expectations. I look at the psychological aspect of how people view stocks, how the market views stocks. I look at short interest scenarios, and that's very much based on the fact that equity markets move not necessarily on outcome, but outcome versus expectation. So it's the shock that moves markets, not the actual result. Obviously, risk management is key to running capital across any asset class. But we do things probably a little bit firmer than others out there. And that suggests that every single stock that we trade, whether that be a long position or a short position, all have a limited downside protection situation associated with those stocks. And some might call that a stop loss. Ours is slightly different. And that is that we have our technical analysis brings forth 7 to 10 stories or analysis that we believe there might be some juice in the story. If that story changes or doesn't, the outcome isn't as we expect, then we remove ourselves from that position. So it's not as if we buy a stock at 20 and then we put an 18 stop loss onto that position. That's not how we work. It's not absolute. If the reason why we have bought or sold a stock has changed, then we will exit the position. So for example, if we were to buy a stock at 50 with the expectation that in 2 weeks' time it needs to be trading at 53 or 54, and it does not happen, then we might sell that stock at 51. So we've been stopped out of that position, not because it's lost any money, but because what we believed was going to happen has not happened. So we're not specific trade. We might come back to it, but what we do not do is change the story relative to the position. So you do see that, and everyone's been guilty for it. They'll buy or sell a stock for a reason. That reason doesn't happen, and then that position turns into a long-term holding for that person. We don't do that. So our risk management is absolutely preservation over capital returns. We do very differently to others out there is we have liquidity controls on our portfolio. And the reason for that is we've traded through some highly volatile experiences and scenarios over the time, and we have found that when it gets challenging and volatility rises, often you can be held hostage to market conditions. So we don't want to be in that position. We hold basically 1 to 2 days of volume per stock at a maximum. Why is that? Well, that means that theoretically, in a week of trading or slightly higher, we can unwind the portfolio at our own discretion. So we'll never be a forced holder over a 2 to 3 week period. So when we talk about liquidating positions and so on, we'll never be in a position where it's going to take us 3 weeks, a month, 6 weeks to liquidate positions, because we have liquidity controls relative to the size of the position. So that means that we will be slightly smaller than some funds, but we're happy with that. And it means that our destiny will be in our own hands. We get to control our process. And that's really important, because in that case, we don't need the market to go up, down, or sideways. We can continue to return capital to investors irrespective of market conditions. So what do we do differently? Well, as we mentioned, the size aspect. We're not going to be a massive fund. Having managed upwards of $500 million in London, I understand and have witnessed scenarios where fundies, individuals, whoever it may be, have been forced to act in a way that has not been of their own choosing. So the analysis suggests that we'll max out at between $80 and $100 million, and it may happen sooner than that, it may happen later than that. But if we have to dilute our performance and dilute the stocks that we're looking at relative to size, then we'll close the fund. This is a performance-related fund. So the idea is not to manage $1 billion. The idea is to create that 15 to 20% annualized return. We think we can do that as long as we keep our liquidity constraints under control. Everyone who runs a fund, or fund managers, all have fantastic experience, and that's no different here in Australia. There's some exceptional fundies out there. And saying that, I wouldn't swap my experience and my learnings with anyone. Again, I was very fortunate to have an education that I did overseas in global markets, and particularly in fundamental analysis and risk management, has put me in good stead to navigate various different scenarios. So my experience is different. And of course, we have high levels of discipline in our risk management systems. Others have that as well. We painted a picture of an absolute risk capital process. There's no emotion, there's no changing of scenarios. Every stock has this capital control or risk control associated with it. So capital preservation remains and always will be our highest priority. Those three elements are pretty standardized. You'll hear other fundies talking about similar things as well. The one thing that we really do differently is low correlation, almost correlation of zero, really. And I'll explain what correlation is. So correlation is if your fund let me start that again. If the market goes up 1% and your fund goes up 1%, you have a correlation of 1. If the fund goes up 2% relative to a 1% move, which is an idea of leverage essentially, then you have a correlation of 2 or 2 times. Our correlation is 0. So we're as likely to make a positive return if the market is down 1% or if it is up 1%. And that's not necessarily a deliberate choice. We don't thrive for that, but the way that we trade, running a long and a short portfolio, and the way that we use preservation of capital and liquidity constraints means that our correlation is essentially 0. And that's really important for us because, as I hinted to before, we do not want to be held hostage to market conditions, and we don't want to have to wake up every day and check our phones and go, oh great, the market's up 4% or the market's down 2%, we're in trouble. That is not how we run a fund. We run a fund through our own process. So we really do not care if the market goes up, down, or sideways. It's important. That is important. It's not deliberate, but there is a case study I can explain later if we wanted to go into some further detail around correlation. But it is important because we want to make sure that we can control our own process. As we said, we're not here trying to predict whether the market goes up, down, or sideways. So that is slightly different to some other funds out there. As we touched on before, we do have a philanthropic edge similar to what Trade for Good does. We have no issue with financial markets, capital markets. The only issue we have is that by definition, we look after wholesale investors. And that means that very, very simplistically, most of our investors that we look after, including us, are wholesale. So we are limited in terms of what we can do to help those that probably need it more than us. So our goal is always to create wealth, and that's our expected return. What that creates wealth. What we hope to do, and we hope to show an example of how we can redistribute that wealth in a more balanced and even manner. This is obviously something new. We haven't seen anyone else do it in the variety that we're going to attempt to do it. But look, I love what I do. I love trading. I'm okay at it. And I think this philanthropic element to it has given me some drive to continue on and to push forward. So it will be part of this fund going forward. How we do that? Well, we aim to donate 1.25% of our funds under management to charity or our charitable partners each year. We do that in a variety of ways. Westbourne Asset Management will part with part of its fees, so we'll give away part of our fees to top up that 1.25 as a minimum. And also, we're excited to say that we'll be trading with Trade for Good. As we know, Trade for Good donates 50% of post-cost commissions to charitable partners. So given that we are an active fund, given we have high turnover and we'll always be trading, we don't necessarily use outside research, there's no opportunity cost if we trade with Trade for Good, Canaccord, Morgans, Merrills, or whatever. So we will be sending, hopefully as we grow and as we go through the years, we'll be sending plenty of flow and execution through Trade for Good and enabling us to donate that at minimum 1.25% to charity. We thoroughly expect that to be a minimum, and the charities that we've chosen target youth underprivileged across health, education, and housing. They'll be our initial partners. But we certainly have chosen outcome-related partners in charities, and the reason for that is we want to leverage the results of our philanthropic endeavour, our network, and hope to show the market, show the financial markets and capital markets that it's quite easy to make change if you set up the structure and the infrastructure to be able to do that. So that is our goal. As I mentioned, these are our 3 initial partners. We've got Mornington Peninsula Foundation, Children First Foundation, and Cottage by the Sea. We can obviously go into more details why we've chosen those. In terms of us, that's Charlie Burgess, Silk Group is the administrator, as we mentioned. Trade for Good will be using us as our execution partner and have been over the last 6 months, and that will grow. And then obviously there's the fund account. So that, Alistair, is the very short and sweet synopsis of Westbourne Asset Management, Westbourne Absolute Return Fund, and the CIO, myself, Charlie Burgess. So hopefully we've got some questions, if there is any.
Yeah, well, I've got one off the top. That was awesome. Thanks, Charlie.
No,
obviously, it's hard to summarise what you do in 20 minutes or however long it's been, but it was a good job. So I've got a question. You do talk a lot about coloration and how that's important to you.
Yep.
Do you want to just maybe touch on that a little bit more?
Yeah, sure. So the correlation aspect is we just don't want to be a derivative of the market. So, some funds out there, whether it be long onlys, and their goal is to outperform the market, right? So if the market's up 4 or 5%, they want to do better than that, and they want to outperform their peers and so on. And that's great. I have no issue with that. But the one issue that we have is that, if the market, if we have another GFC or if we have a COVID situation, there's really not much you can do about it.
No.
If you're in that state and you've got exposure, then you are sort of held hostage, or you're a derivative of the overall market. So the market goes down, you'll underperform, or your assets will decline. I just don't want to be in that situation. I saw it during the GFC. There's situations where world-class managers would ring up, and money managers would ring up and say, here's some stock to sell. And I remember specifically there was an order that was in Glencore or Xstrata, and it was, sell $10 million of these and wake me up and give me a buzz when it's down 10%. And I was like, well, it's up 2%. We'll be okay. I'm not going to butcher it. I'm not going to. Hopefully, it's not 10%. Funny enough, I call him back half an hour later and say, okay, yeah, as you suggested, the stock's down 10%. How would you like me to proceed? Yeah, the story goes that it was continue to sell. But the point is that what he was witnessing in his institution, he knew was across the street. He knew that was 15 funds in the same situation. Yeah. So they were all forced sellers. They had liquidations, they had redemptions. They couldn't do anything about it. So I just don't want to be in that situation. And it was lessons learned. And in fact, there's probably, if I go back to, if you want to share that screen, I've got this slide in my pack because I get a lot of questions around correlation. And 2020 was obviously an interesting time for markets. And I've put this chart, we did okay during 2020. We do like trading in volatility, and we had no correlation. So if you look at specifically March, you'll see the market, and if you remember, we probably have lost recollection of that, when the market lost 20% in 1 month period, which was an amazing situation. And the fund made a positive performance in that. And the situation will be, well, how is that possible? People will get a lot of questions about how that worked, and run me through how that happened. And if you go back to what we were talking about around risk management, liquidity, and how we only hold a certain amount of stocks, and every position we have in the fund has a stop loss or a capital preservation associated with it, then if you go to the month early and you see that the market was down 8%, then you can probably think about it logically. If the market's down 8 or 9% in February, then the chances of me or the fund bringing any long positions across into March is quite low, because in reality, we're probably going to be stopped out in most of those positions, and that's exactly what happened. And there's two aspects of capital control and risk management. One is when you're wrong, or when your story, in my case, or in our funds, when your story changes, to react and to act on that. And so we did that. The other side of it is when you're right, it's vitally important that you let your winners run. And you do that so that you don't have to be right more than 50% of the time to make consistent positive returns. You just have to be extremely disciplined. And so what happened in March was we basically got stopped out of pretty much all of our long positions, and we kept our short positions running. So we had probably 4 or 5 short positions that we had in February, and we had maybe 10 long positions, because obviously January was a good month as well. So come to March, then we have a situation where we've got 90% of our longs have been sold or stopped out. Our shorts are making money, and hence we've got a positive return. So in isolation, it's a challenge to look at it and see how that's possible. But when you look at it in terms of our scenarios, then you can understand it. In fact, if you look at the next month, the market bounced back 9.5%, and we only made 3%. And if you can go all the way to November of that month, it was the best performing month for the market in 2020, and we had our only negative month in that period. So I talk about zero correlation. This is negative correlation. So we're actually making money when the market goes down, and we're losing money when the market goes up. And that's rare. We don't try and target that. We're not a negative correlated fund. But you can see how we don't care what happens to the market. The idea is we use the share market to create a return for our investors. So I think this is probably the best example of correlation and how uncorrelated we are with our returns. Now, this smooths out. As I said, this is a negative correlation period. It smooths out over time, but even so, it meant our 5-year correlation is slightly above zero. So, as I said, it's not deliberate. We don't go out there and say, we have to have zero correlation. It's just it's an off tap of our process. It's just the way we work, and we're very comfortable with that. So hopefully that answers the correlation.
Yeah, that's fantastic. It's certainly it's an interesting way of looking at it. And as you said, you don't want to be tied to a market if it's you want to make money going up or down. Right?
People, it's different. There's different classes of fund managers, and some would say, we look at the best young companies in the Australian share market, and we do deep dives in it, and we look at them fundamentally. We have meetings with the CEO every month and stuff. I don't do that.
No.
So I would never pretend to outperform those fund managers. I've got to do something a little bit differently. I don't have the capacity to do that. I don't have a team of 15 people working with me. So that's great. But to be honest, even if I did, I wouldn't be able to do it. It's just not in my personality. You have to marry up how you would like to trade, and it keeps going back to that background of me. The things that I saw in Witnesses. I just could not go and put my head on the pillow at night knowing that I have $80 million of other people's money and my own. And if the market's down 3% tomorrow, we're going to lose money. That's just, I can't get my head around that. I've never been able to do it. And so the fund that I've set up is, it avoids that situation.
Yeah. And I think one of the other things with your fund is the performance side of all, the performance fee side of it. Something you and I have chatted about before. It's like when you go, the market's down 4% and the fund manager will go, oh, great, we outperformed the market because we're only down 3%. And we're still going to pay our performance fees, but that's not your mindset either, right?
Well, no, that I wouldn't try not to talk about others, but if the market's down 10%, we still expect to make money.
Yeah.
And as we're not using it, like I said, it's just a tool for us. It is really just a tool for us. We don't look at things relatively. We always put our performance versus the market to give an understanding of what makes us tick and where we perform well. And to be honest, our best market is when it's volatile, because we can change our expected horizon from a 3 to 6 month view. Sometimes you can get that alpha or that that volatility in 3 or 4 days.
Yeah.
So you can adapt to that. Others can't adapt because they're slightly larger. But no, we'll never go, oh, the market was down 10 and we're really happy we're only down 5. That's not how we work. And look, when the market, if the market goes up 20% in the next 3 years, every year, I'll underperform those funds that have got leveraged exposure.
Yeah,
they'll make a fortune, and good luck to them. That's just not how we work.
No, fair enough. Well, interesting. We've just a couple of questions coming in off the and talking about volatility and choppy markets. We've certainly seen that with our friend Mr. Trump.
Yeah.
So, what do you see as risks in the current market?
Well, yeah, I love these markets. I love it when the volatility is there. It's, Australia's not the most sexy market to trade. So we're probably a little bit dull in terms of a global scale, but certainly it's been very interesting recently. Look, there's two, I'll look at it from the upside and the downside. Obviously there's always going to be headline risk with Trump. He's a markets guy. People will say, he doesn't care if markets go up or down. He does. What I would say is that he's in the first period of his term. There's no midterms this year. And there's this saying, you hear in capital markets where you kitchen sink things. And I think he's made a specific effort to do the hard work now. And in fact, look, for the downside, the greatest risk is always going to be the debt cycle and what how he manages that. We saw during the tariff discussions when China started selling bonds and yields started raising. Those were very interesting times, and so there's a very strong balance there between how the bond market in the US performs relative to equity markets, and I think that was probably not celebrated enough. There was a lot of tariff chatter, but really markets when it was selling off aggressively, that was in response to the moves in the bond market. So, if there's a situation where China keeps selling bonds and yields go up, well, that's not great. That's the same as we saw in the European crisis, where Portugal's bonds were yielding 18%. That's because they were viewed as risky. There was a chance that they're going to default. Yeah. If that happens to the US, that is a real domino effect that can move on. In terms of the risk metrics of the market, I look at the gold price and I look at those long-term bond yields and see how they're performing. And if they're coming off and they're healthy, then everything is normal.
Yeah.
And that's good. That's a good situation. So that's all come back a bit. Gold prices come off a bit. Obviously, there's some correlation there. When money comes out of the US, it has to go somewhere. So that's the downside, keeping an eye on those catalysts. I'd say from the upside, as I mentioned, I think Trump's pushing really hard to get a lot of this done as quickly as he can. And not many people are talking about this, but next year is 250 years since America signed the Declaration of Independence in July 4th, 250 years ago. Now, if you think that the Don is going to let negative growth and recessionary fears and all that sort of stuff be on the cards next year, I'd strongly bet against that. So I would be unsurprised if we're currently in a recession now in the US and even we have another quarter of negative growth, and I don't really think he cares. I think he's going to set it up to succeed next year and have quite an aggressive growth and consumer expectations, and I'm sure he'll cut some tax breaks for the middleman in America. So I think it'll be a very, very strong celebration of growth and demand. And if everything else stays stable, I wouldn't want to bet against that next year.
Yeah, so, interesting.
I'm relatively, and I'm quite a pessimistic person when it comes to looking at markets, but if you ask me next year where we are, I think we'd have some pretty surprisingly strong growth numbers. It's all relative. If growth is poor this year, it just makes next year's numbers look better. And when we look back on the centenary year, 250 years, I think that's the game plan. So I think there's a lot of movement happening here that maybe Trump doesn't get credit for. We'll see. There's some extreme variables there always, but with geopolitical things seemingly calming down a little bit, he's been in the Middle East this week and making deals, which is very good for growth. It's very good for the region. You saw the last night or the night before Moody's downgrade America's debt. No one cares. That has happened before. That has happened before. 2011 and 2023 where we saw Moody's downgrade, and performance post that wasn't fantastic. So we'll see. But I think, look at that. I think Moody's also gave subprime AAAs a tick in September 2007. So they don't have the best track record. So take that with a pinch of salt. But it is always worth, because that's always related to the debt and that aspect. So it's always worth keeping an eye on those sort of things. But yeah, no, I think this year will remain a bit choppy as we get a lot of headline risk, and then I think next year will be a positive year for markets. One thing you always need to remember is the share market isn't the economy isn't the share market. So the share market will always look forward, whether it be 6 to 12 months. So if there is some look through to next year and things start looking good, the market will go this year quite aggressively. Yeah. So, and the one other thing I'll say is when you have these moves that we've seen where markets fall very rapidly, the worst thing that can happen is it stays there because you get liquidations and you get redemptions. Yeah. And so the fact that we've bounced back so aggressively can be seen as relatively positive. And if you look back and backdate moves like that, it generally has a good view for 6 to 12 months. And what happens is as well is that when you go down, everyone's a forced seller.
Yeah.
And if you don't buy it on the way back up, then you're all of a sudden underweight. And that's what we've seen. So there's been a lot of short covering. There's been a lot of people balancing their portfolios, because the last thing you can do when you're a sizable fund manager in the US is underperform. You have to outperform your index or your benchmark. So in that way, some ways, the aggressive bounce back in markets it's been a real challenge for some people, because markets, I mean, we're above where we were pre-tariffs. I mean, that's quite rare to think about, isn't it?
Yes. Yeah, that's a really good point. Yeah, wow.
Doesn't feel like it.
No,
it feels like there's a bit more blood on the street than that, but certainly, mildly positive for next year.
Oh, cool. I mean, obviously, the most important, from an investor's point of view, is performance.
Yeah.
So maybe you could touch a little bit on your, previous performance and what your expectations are for the fund.
Yeah. So I mean, we're always, past performance is not a good indicator of future. All of that. Look, the way that I run the fund is very consistent and has been, very process driven, very capital disciplined. So my returns are pretty consistent over a period. Since I've been doing this in 2007, I sit at about 17% annualized in Australia.
Nice.
The last fund within this strategy was, I think, 15%. We target that 10 to 20%. I do have a slide of past performance. I don't know if you want to pull that up or...
Sure.
Yeah. So, there's some volatility in returns there. As we mentioned, we always look at it on a 3 to 5 year view, but, there's the last fund annualizing around 18%. So very similar. The idea is, my personal goal, I probably wouldn't put this in writing, is, I want to double... I'm the biggest investor in the fund and always hope to be. The idea is to double your money every 5 years. And if we can do that 15% annualized return, we'll get those numbers. So that's the goal. I look at things on a short-term trading. I try and eke a little bit of performance out of the fund, out of the market every month. And that's pretty standard. These numbers would be similar. So there we are with the live performance of the current fund. Again, there's hardly any correlation. So at the moment, we're annualizing, around 14% there as well. So the market's, I think this was done at the start of May. So yeah, we're outperforming. We expect to outperform when markets are volatile, and we probably expect to underperform slightly if markets rip away from us. But we're really comfortable with that. So we'll always give up a bit of upside, and the fact that we're active trading means that sometimes we miss opportunities, but hopefully the idea is to protect for the downside. So we'll keep doing that, targeting those returns. We want to grow it. We want to grow the philanthropic side. So there's plenty to work for.
Yeah, that's fantastic. Well, thank you, and thank you for being our first Meet the Manager.
My pleasure. I
don't know if we'll come across many like you, but we'll try. But we can keep in contact.
Absolutely. If things, come
in again, if it's your update.
Yeah, if it's when markets are interesting, there's obviously I get a lot of questions relative to when I send out my notes to clients, and it's the same. People only really care when it either gets challenging or when it gets volatile. That's when they look at their portfolio.
Yeah.
If and when those markets come back again, I'm happy to sit down and have a chat.
Awesome. Well, thanks again.
Thanks, Al.
Pleasure,
Good to
mate.
be here. Good
You
to be
too.
here. Good luck with everything we try for good.
Thank you, mate. Same to you.
Cheers.